Hey everybody, Mitch Wilder here with the Ahead of the Curve podcast. And of course, I've got Micah Frame with me today. And today, Micah is going to help us to see, should we do the standard deduction or should we itemize our deductions? And how does that work since the changes in 2018? So Micah, go ahead.
Yeah, so the vast majority of taxpayers, at least the ones that we dealt with pre-2018, would itemize. Because for single individuals, the standard deduction was a little over $6,000. For married people, it was a little over $12,000. So itemized deductions, the most common ones include what they call the SALT deduction, the state and local tax deduction.
Yep.
So that's the state and local income tax you pay, personal property taxes, real estate taxes, and then there can be miscellaneous ones, but those are the main ones. You've got your mortgage interest. In prior years, you used to be able to deduct PMI or the mortgage insurance that you would have. You've got charitable deductions, and then you also have medical expenses subject to a threshold of some percentage of your adjusted gross income. So anyway, but when the standard deduction was lower, it really wasn't too hard to get over that hump. If you owned a house, the vast majority of the time,
the interest alone would probably put
you were going to be itemizing. But then when they redid the tax code with the Tax Cuts and Jobs Act, they more or less they got rid of personal exemptions and dependent exemptions, but they also doubled the standard deduction. So for 2023, that's $13,850, and for married couples, that's for single individuals, and for married couples, it's $27,700. Okay. So we're a good bit higher than that now. That's the first hurdle that you've got to overcome.
Right. Well, and it's interesting you said that. I did not realize that was part, I guess, an effect of the Jobs Act. I didn't know that there was the connection there. That's kind of interesting. Yeah. That changed a lot. I mean, the Jobs Act changed a lot of financial regulation.
Oh, they changed a ton of stuff, and it's funny because it was done ostensibly to simplify the tax code and how you could do your taxes on a postcard and make it so much simpler. And for certain people, it did. If you were someone who just has a W-2 or you didn't have much itemized deductions, it made it a little bit simpler for you. But for anyone with a business, anyone with a slightly more complicated tax setup, it made it much, much more situation specific nuance. It takes a lot more planning. There's a lot more opportunity now, but it did not simplify the tax code for the majority of taxpayers, which was on its face supposed to be the idea.
It's usually how it goes, right?
Yeah, right.
So,
yeah.
Well, so you know, it seems as simple. It seems like it would be as simple as, okay, if it's I'm married, it's 27,800, say 800, 700,
but it goes up a couple $100 a year, so it's not that's the ballpark is really what matters for this.
Let's say 28,000 ballpark, right?
Yeah.
So the thought, you would think, okay, if my deductions are above that, then I should take the standard, or excuse me, I should take the itemized deductions. Right. But as we talked about before recording this, that's not necessarily the case. So can you kind of show us an example of what that would look like and explain why that's not the case?
Yeah, absolutely. So the two main things that we're going to look at that people won't realize is that the state and local taxes, so real estate taxes, state income taxes, personal property taxes, those are capped at $10,000. So it doesn't matter how much you pay, you only get to deduct $10,000. The other thing is that medical expenses are subject to a threshold of 7.5% of your adjusted gross income. So the example we're going to show is, so the first 7.5% is just disallowed. So the example we came up with, I'll read these off here. Let's assume that you're a married couple, you're married filing joint, and your adjusted gross income is $200,000. And then you have mortgage interest of $10,000, real estate taxes of $4,000, personal property taxes of $2,000, state income tax of $11,000, PMI of $1,000. You had $3,000 of charitable donations, and your medical expenses totaled $20,000.
Okay. What was the total of all that?
The total of all that was $51,000. So
we would think you're going itemized.
you're going itemized by a mile, because that's 51,000 and the standard deduction was 27,700. So
Right.
you're close to double that. So of course
Everybody's like, I would definitely be itemizing that.
yeah, exactly. It's just it's a no-brainer.
Right.
So we
But
did, but so
it's very
here's
loud.
so here's the scenario in practice. So you have medical expenses of $20,000, but you've got that 7.5% threshold. So 15,000 of that gets disallowed. You only get to take $5,000. And then you've got all the state and local taxes we noted, 11K income tax, $4,000 real estate tax, $2,000 personal property taxes. So you've got 17,000 of state and local taxes. You only get to take the 10,000 though. So you're capped at 10,000.
And that's capped at 10,000. Even if that was 27,000, you're capped at 10,000.
Right. Exactly. You're stuck at 10,000. The mortgage interest you get to take all of. The PMI you're not allowed to take. And for 2023, that sort of the PMI deduction will expire and then come back and expire and come back. But even if it was allowed for the year that we're talking about, I think the cap is like once you hit $100,000 of income, you can't deduct it anyway. So in either case, you get your mortgage interest, but you do not get your PMI, and then you get to take your charitable donations. So you do itemize. You have $28,000 of allowable itemized deductions, but you're only itemizing by $300.
Yeah.
So again, it's not to say that this isn't worthwhile. Right.
And how long did it take you to get all the numbers for your charitable donations, mortgage insurance, right? If you're a business owner, like your time very easily couldn't be worth $300 per hour or more.
Right, exactly. And that's $300 of deduction. So in that scenario, you're maybe getting $100 of tax benefit. And that's not to say that we don't have clients who, I should note, there are other itemized deductions out there. Like you can deduct your gambling losses up to the extent of winnings. You can do casualty and theft losses.
Always make sure I lose.
Yeah, just keep losing, just burn. So there are other sort of miscellaneous itemized deductions that are out there, but those are by far the ones we list are by far the most common ones. So what we'll tell people to do is just look at kind of the big categories you have and do a little back of the envelope calculation, see if it makes sense at all. Because if you're going to be nowhere close to itemizing, we don't want you to go through and add up, find every receipt you have for CVS for $15 and add all of those up, and you had a couple $2,000 of medical expenses, and the threshold you'd have to exceed is $12,000 or something. Like,
right.
So again, we have plenty of clients who itemize. It can save you a lot of prescriptions. We've got a ton of people who itemize still. So it's not that this is like, no, it's not worth it, nobody ever does it. It's more just, like you said, not wasting your time doing a quick ballpark of what it looks like based on the large items, and then deciding based on that if it's worth it to spend all the time calculating the smaller items and gathering that information.
Right. And I imagine in many cases it is, but I think that those caps that are put on there, like the mortgage insurance, for example, I mean that, or excuse me, not the mortgage insurance, the mortgage interest, for example, that cap is like, how many people are not going to hit that? I mean,
the medical.
Well, cap? The medical, but I mean the mortgage interest,
the state taxes,
or the state taxes. I'm sorry, the state taxes.
No, you're fine. Yeah. Oh yeah. Well, that's what we like. You can have people who are in really high income. They're high earners and they're in high income states, where you can have $50,000 easily just in state and local income taxes. You've got someone who's living in New York City or something like that. So they're way past the standard deduction just based on that, but they only get to deduct $10,000 of it. Yeah. And again, we did that video a while back on the new pass-through entity tax election that allows people to pay the state taxes at the entity level. And that cap is the main reason that came into existence at all.
Right. And it seems like they're always trying to do something to make it more simple, right?
Mm-hmm. Right.
And, because I mean, the thing is, you've got, hundreds of millions of citizens in the United States. Not all of them pay taxes, right? We know that. Only actually a relatively small percentage actually pay taxes, right? I want to say like, I won't go into it. I looked at it recently, but it's probably way off. But anyway, not all of them pay taxes. And so the ones that do and that are paying taxes, like, you don't have anywhere near enough IRS agents to support looking into this unless the system becomes more simple, right? So it makes sense that they would continue to try to make efforts to simplify. The problem is it seems to have a much bigger impact on the people that are the vast majority, right, than the people who you would think it would have the impact on, but it just doesn't work that way.
Yeah. And yeah, whenever legislation comes into play, there seems to be some unintended consequences. And I understand partially why they did it, especially for the fact that the IRS is way understaffed and way underfunded, and they're getting all this pressure to do more audits. If you have simple and good or bad, the majority of the audits the IRS has been doing for years now are on lower income people with simple tax returns.
Right.
And for those audits, if you're going to do them, you're just doing, you've got income verification, which could just be a W-2 or two. And a lot of times they'll be targeting people who got the earned income credit. And then a lot of times it's just verifying the income and are these kids actually yours? And boom, you're pretty much done. Versus if you're auditing a business of any sort of consequence or any sort of complexity, I don't know what the ratio of how many simple audits you can get done versus a complex audit, but it has to be.
It's got to be
many, so many,
100 or more.
And again, from a policy standpoint, that's not necessarily the great thing, because there's more potential for abuse of people who have more resources and have complicated situations versus the person who just has a job and is getting earned income credit. But that's how the enforcement activity has gone lately, at least.
Yeah.
So,
well, I mean,
it's one of these things where, again, 51,000, people look at that and say, boom, I'm going to itemize, but they throw in these little hoops that you have to jump through and these little caveats that most people aren't going to be aware of. And then us as the tax preparers have sometimes fine, sometimes unpleasant conversations where people are like, what are you talking about? I had $80,000 worth of itemized deductions. We're like, yeah, you sure did. But when we run through it, this is the way it goes. And
yeah. And of course, like you said, you've got to be the one to tell them instead of the IRS.
Right, exactly.
So, well, and to your point, I think it's just interesting to mention, how this tends to affect, people who don't have the resources to understand how it works, right? They're going to an H&R Block, they're going to, their local, very, very cheap, tax however they're doing
they're doing it right? They're doing it online,
doing it themselves
or something, and they don't understand. I mean, why would, and to be clear, why would they? They've got no reason to know any of this.
Right. But, we were, before this call, Micah and I were talking about a tax attorney that we know, and he posted something on Facebook about, how one of his clients got a bill from the IRS for, I think, what did it say, like 156,000 or something like that. They're like, business owner so-and-so, you owe us 156,000. And so immediately the way that goes is you look at that letter and you pick up the phone and you call your tax attorney, right? And so tax attorney sends a few correspondences to them about why he doesn't owe that, and the IRS is like, oh yeah, you're right, and the guy ended up owing nothing, right? Because he had the resources and the connections to be like, no, I don't think this is right. How if somebody is like not even anywhere close to that, the I owe 5,000 or 10,000 or 15,000, where a tax attorney is not even going to get involved, it's much more likely that they're going to collect on that than the 150,000.
And that's where it gets really sticky, because we don't do audit representation anymore just because we cost as much as a tax attorney, and clients don't get audited that much. So it's something we're dealing with once every couple of years. But that's where it gets really sticky, because for a tax attorney or any sort of audit representation, that time adds up very, very quickly.
Yeah.
So when you're looking at, even if you disagree with the IRS, maybe you write a letter or two, or you put some effort to get it resolved, but you can't pour but so many resources into the defense against the audit when the amount, your defense efforts are very quickly going to reach what they're asking for anyway. And the defense efforts aren't a guarantee that you get any or all of that proposed amount knocked away. So it becomes good or bad. It does become simpler when there's this huge gargantuan amount that you can't ignore, and you have to fight, and you have the resources to do it, versus if it's kind of this, when you're having to weigh the cost benefit of fighting, that's when it gets more difficult for people to decide what exactly to do, especially if their resources are limited to begin with.
Yeah. And I want to say, I've had a couple conversations with some of these guys over the years, and it's an interesting, the tax attorney business model is really interesting to me, because it's like, they'll tell you, I remember one of the guys, he's like, if it's 50,000 or less, just make a payment arrangement. He's like, not even worth it, not even worth it.
I remember, what were the ads for that were on?
If you owe 10,000 or more,
who was it Ronnie Deutsch or something? I feel like, I think it was $10,000, but
I remember it was 10,000 or more.
10,000 or more, and I can't remember. There was some.
We used to do some of those ads. That's why I remember the 10,000s. We used to do some of those. We were a lead vendor for them years and years and years and years ago. Yeah.
That's fun.
Yeah. So, but I remember specifically the 10,000 because I wrote it in ad copy 60 times.
Yeah.
So it's interesting because one of the things I think is interesting, we've done several episodes. We're going to continue doing episodes. We get such great feedback from the people that watch this. We've had a lot of people call, schedule calls with us, and, people just don't talk about this, and they just don't understand it, and like you said, like, why would you, right? That's not your job. But I think that what happens so often is that they end up, because of not understanding it, they end up in a situation at some point in your life, at some point in your career, where you are forced to understand a good portion of it. Right. And that, from experience, is one of the most frustrating things, right? Because it never comes at a time where business is doing really, really well, right?
Right.
It's always like, we've had a bad year. Oh, by the way, what's this letter that we just got from the IRS? It never is on like, oh, we just had our banner year, so no problem, we'll just write the check, right?
Yeah.
And it's always something like that. And it's frequently something that was really not your fault. Like, it was something that's avoidable.
Right, exactly. That's the problem, is that and again, we don't expect people to become accountants, but the problem is because there's nobody understands it. The accountants can't explain it. The person doesn't really want to understand it. You go through these long periods of not understanding the core concept, and then after the fact, when it's too late to really truly fix, that's when you get hit with it, and that's when you're forced to understand it, versus getting a baseline knowledge earlier and at a time when you can still maneuver and adjust things and not just get hammered. Right.
Well, I mean, I know you're not a huge fan of Robert Kiyosaki.
Yeah.
I know how you feel about Robert Kiyosaki. He's getting pretty out there. But anyway, one good point that he made, because when I was a teenager, I read the Rich Dad books. Those are good reads for entrepreneurs. Gets you to think a little bit more about money. One of the statements that he made in that book was that the rich understand how taxes work, right? And when you think like that, if nothing else alone, just that on its merit, that's a really good point. The rich do understand how taxes work. They're not necessarily an accountant, right?
Right.
But they understand how it works, because taxes are one of your biggest expenses.
And maneuvering around them allows you to maintain that wealth. I'll have my clients do quite well, but some of them are attached to people who do astoundingly well.
Mm-hmm.
And so occasionally I'll have conversations with the things that they're doing joint ventures or have partnerships with. And on those calls, these people aren't accountants, but they understand the tax code about as well as most accountants do. That's
Yeah.
the level of familiarity they have, because when you're worth X millions of dollars and you've got this huge, you have to, just from the opportunity cost standpoint, because
Right.
for an average entrepreneur, if you have a decent accountant and they're doing things correctly for you, the juice might not be worth the squeeze of you digging into it
Right.
and learning, because, okay, you might save yourself a couple $1,000s and that's great, but it's not worth your time. But when you're getting into 7, 8 figure incomes and investing portfolios, the opportunity cost of not knowing that becomes so much greater that these guys really are forced to dig in and become
Right.
quite good at understanding the concepts.
Well, I mean, when you and I first started talking years ago, right? I imagine I asked you questions that the majority of your clients weren't asking, because I was
Oh, yeah.
just so curious about how taxes work,
Right.
and it was like, I know that this is important, because if I don't place importance on it, it's going to cost me 20, 25, 30, 35% plus of not
Mm-hmm.
only the income that I have now, but of my future income. Right. When you
Yeah.
think that when you extrapolate, if we're looking at just what the top
Mm-hmm.
tax bracket is right now, 37%. If
Mm-hmm.
you look at just what that is right now, you extrapolate that over, let's say you make $1 million a year, right? And that's $370,000 a year in taxes. And then you do that for 10 years, right?
Right.
That's $3.7 million in taxes, because of something that you may not have understood.
Mm-hmm.
Right. And I mean, last year we were doing a refinance on our house, and when you understand taxes and you optimize yourself for taxes, the warning there is that it's not easy to get traditional loans. Right. That's the downside of it. But
Yeah.
I kept having some people through the process. They're like, well, I don't understand this. I don't understand this. I don't understand this. And it's like, these taxes that you're paying, I legally am not paying those,
Mm-hmm.
right? Because
Right.
of this tax optimizations. And people who don't understand, they just can't wrap their mind around it. Like, how is it that you make so much more, but you pay like the same in taxes that I do? Right.
Right. And yeah, and again, that just goes to optimizing business structure, the deductions you're allowed, because you might have the same inflows and outflows of somebody, but that doesn't equate to taxable profit. And
Right.
that happens when people are W-2 employees and you have very, very little flexibility in that setup, to where your income is right here and there's not much that's being knocked off of that, versus entrepreneurs or people with different investment portfolios. That's the reason we work largely, and not exclusively, but so much with business owners, because that's where we can provide so much more value,
Right.
is because there's so much more flexibility, versus someone who, financial advisors love doctors because doctors are high earners. They have high, they end up having high net worths after they pay off their loans and get rolling. So for a financial advisor, those are the perfect clients. For us, there's not a whole lot you can do, because most of them, unless they're contractors, they're W-2 employees. So it's okay, same thing. Give us your mortgage interest, your real estate taxes, give us these things, and maybe we can advise on helping them with some structures for their kid. Like, there's some things you can do, but it's very cut and dry for a lot of it,
Yeah.
versus a middling entrepreneur. We can provide so much more value to, just given the nature of their tax setup.
Yeah. Yeah. It's very, very interesting. We should do another episode where we talk about, things about taxes that you should know. And, as an entrepreneur, because I think that there are some things where you should know it. And then you get into, like, I went to a conference and I heard this and it sounded really cool. And then the reality is like, yeah, you probably shouldn't know that. And you probably shouldn't do that. That's a little bit more dangerous,
Oh yeah.
and you,
Especially
you and I know what that's like.
Oh man, I mean it's crazy the things that people will pitch that I'm like, yeah, that's illegal. I know that
Yeah,
some
that's straight
guru
up illegal.
at
You
the
should not do
conference
it.
at the conference, but the amount of people who will talk about like get a hot tip to basically commit tax evasion by offshoring all their profits. Like, how about I set up an entity in the Cayman Islands and it charges me a commission, and that way I'm like, no, that's very, but
That is
that's
its
the stuff
evasion.
that is the thing that is some of the stuff you have to fight against, is the people who hear
Yeah.
something at a conference and it sounds amazing,
Yeah.
except it's illegal.
Right. Well, and there is obviously like all the stuff you and I have always talked about. Like I've always told you, I'm like, I want to be as tax optimized as is realistic, right? Like
That's what you should be.
Yeah, there's also a tipping point where you can spend too much on it. I know these guys who have tried to save millions or tens of millions of dollars, and they're like, I saved $5 million in taxes, right? But but it cost them $4 million in legal fees, and it was complex, and it took up all their time.
All
At a
their
certain point, it's just
time,
not worth it.
and sometimes there's very few truly like free lunches when it comes to tax code, and some of these things that can be and are very good maneuvers do come with some sort of downside.
Yes.
There is some trade-off in terms of the liquidity, access to the money. Like there's usually something that you've got to weigh against if it's worth it. And again, sort of on the flip side of people who don't understand anything and don't want to understand it costs them all this money, there'll be some people who borderline obsess and who their time is worth $500, $1,000 an hour, but they're reading tax blogs and then sending them to us saying, hey, is this something we should do? And I'm like, no, of course.
If it was something you should do, we would have told you about it.
Talk about
right.
Yeah. So there is a trade-off there of being familiar enough and understanding the core concepts, but also focusing on your actual core competency and not investing. Surround yourself with experts and a team that you can lean on versus trying to become a financial advisor, CPA, lawyer, SEO specialist, whatever. Don't because it's hard to account for the hours and experience that anyone who's in professional services has built up trying all these things versus the front 2 pages of Google giving you hot SEO or marketing tips that a real marketer could tell you, like, yeah, I know the strategy, it hasn't worked for about 3 years and it won't work in your industry for X reason, or there's a lot of reasons why these people aren't suggesting
it's only showing
things
up because it's old. right.
Yeah. It's got some nice legacy
yeah but I mean
authority to it.
I was listening to it's an old video that Alex Hormozy put together about this particular topic, and I've seen several people do that, where the thing you've got to realize about tax planning is that you and I talk about like systems all the time, right? And I always tell you, like, you're not looking for a system that takes 100% off your plate, right? You're typically looking for a system that reduces the amount of time that you're spending by, let's say, 80%, right?
Yeah.
That's huge, right? You got 100 hours, you reduce it by 80%, you've reduced 80 hours thanks to that system, right? Everybody tries to go 100%. My point is, after the 80%, you just start to get diminishing returns.
Yeah.
And it's the same thing with tax knowledge and tax planning. Is you want the 80%, right? You want to know the 80-20 of it is know the 20% that gets 80% of the results.
Which won't take you all that long to learn.
Right.
Like, for the purposes that most entrepreneurs or really high net worth people need, that's not super, super complicated. The execution, whether or not it works for your situation, that's the CPA's job. But understanding the core concept is not a super arduous or time consuming thing to do. But past that, it's a total waste of time.
Right. Well, and I think, like, for me, I've spent a lot of time understanding various angles of taxes and focusing in on what are the things that are the most important to know. what are the little hinges that swing the big doors and produce most of the savings? I think for me, with the work in M&A and everything, to me it makes sense to learn a little bit more than average, because it's not just impacting me, it's impacting 10, 12, 15 companies that I have equity positions in, that they are now also able to. So it does produce more of an outsized return for me. But like you said, like until you get to that 7-8 figure mark, you don't really need to know that much. You need to know the 20%. These are the things that are important to share with the CPA that are changes, right, that have happened, moved, bought a house, had a kid, right, got married, those types of things. Just basically a lot of it comes down to informing your CPA on what's happening in your life, that they can then say, okay, well then now you apply for this, you apply for that.
Yeah. And
other
the
than
less
that, there's
you're
not
wanting
much else.
And the less you're wanting to learn, the more, especially for business owners or people who have fluctuating situations, the more necessary it becomes to plan with your CPA throughout the year. Because that's sort of again, we always, like, I'll argue both sides of it, and there can be extremes, but where people will run into trouble is when they do have complex situations or things with interesting caveats that you've really got to plan around, and they don't know anything about the tax code and don't want to, and they don't check in with us.
Yeah.
So those are the situations where if you don't want to learn, or you only learn the baseline, make sure you're checking in with your CPA so that we can avoid these kind of, we always say once the year closes, we lose a lot of the flexibility. So make sure you're checking in at least before the year ends to make sure you can adjust as much as possible.
I've got a close friend of mine that I had lunch with when we were out in Maui, and he and I like to go diving together when we're out there. And so we're having lunch and we're talking. He's like, I wanted to talk to you. He's like, we had this really, really big contract with several resorts out here. Like, I mean, those resorts are spending money, and he got this massive contract with these resorts. And he's talking about it and, telling me the things he's going to do. And I said, have you talked to your CPA about this yet? He's like, oh, no, I haven't. Like, I should let them know. I'm like, yeah, you're going to want to let them know. Because it was enough that, like, he needed to restructure his corporation. And I was like, you probably should tell them that.
And even best case, let's just say that it doesn't screw the pooch at all in terms of you have a big tax bill because you had a great year, but let's say there weren't missed opportunities. Let's just go as optimistic as possible, but you have this huge debt now. That can really foul people up just from a cash flow standpoint, because sometimes the business hasn't been doing so well, so they have a bunch of debt they had to take on that then they use that excess cash flow to pay off, and now they don't have the ability to pay the tax bill.
Yep.
Or they just start spending like drunken sailors because they've got all this free money, and then they don't have the money. So just checking in, that's one of the reasons why for business owners, we don't even do just pure tax prep anymore, because there's just too much potential for errors, and what we charge them ends up saving them much more than our fee.
Yeah. Always.
By avoiding these kind of catastrophic events.
Yep. I mean, just even for a mid-sized business owner, one mistake easily can be $25,000, $30,000 in unexpected taxes. Easy.
Yeah.
So always well worth it. But of course, we love talking about this stuff, so we got off way on a tangent. But we need to do another few episodes in the near future. Like in the past, we did that one on should you be afraid of the IRS, which we took away because it was not as good a quality. We need to redo that one because I think everybody here would really like to see that. And then also talking about what things should we focus on, as entrepreneurs when it comes to taxes, like what tax laws should we know? Be great. So so I just shouldn't say maybe, we're definitely going to do those in the near future. But that, and it's fun to talk about, like, that's some of the interesting things with taxes is like, what is possible? What is legal, what is ethical, what's not, to be aware of, so that if you're hearing some of these things and some of these strategies, then you can be alerted, to it.
Right.
You've got a whole movement because of some of these YouTube channels right now where you got guys telling people, and a lot of what they're telling them is legal, but they're like telling them like, move out of your country to a country that has better tax codes. I'm like, that's just too much of a sacrifice, but
right. Oh
I
yeah.
can see like moving to a different state. Right.
Yeah. And I think, I'd need to look at the exact number, but I think moving out of the country, there's some weird niche situations, but usually for most people, you're looking at saving a max of $30,000 a year. That's not nothing. Like that's serious money. But if you have aging parents you need to take care of, you've got your whole network of support. You can maybe make $30,000 extra dollars just staying where you are.
That episode I was watching of Alex Hormozy, he was talking about a friend of his who did that and ended up missing the birth of his kid because of it. And I'm just like, not worth it. Not even, it's just crazy. Having to calculate how many days you've got to be in certain areas, it's just crazy. But anyway, so we'll have some fun with stuff like that in the future, because I love it's so fascinating to see, the different strategies there are. But anyway, sorry to cut you off.
No, you're good. I didn't have anything else. In terms of itemized versus standard, I think we were done about 20 minutes ago.
I know.
So I got my main points out.
Oh, I appreciate it. Well, as always, thanks again, Micah. Enjoyed this and appreciate all the great info on this. And we look forward to seeing everybody in the next episode.